Well, good morning and welcome to our Senior Symposium series. My name is Stacy Nelson. My husband, Willie Nelson, and we serve clients in both Kansas and Missouri. We own Midwest Heritage Homes, which is a real estate team with Keller Williams Platinum Partners. Willie and I both believe that with knowledge comes options. So we offer education on several different topics. Most of the topics are related to real estate, but since one division of our team is specializing in mature clients, we also offer non-real estate education specifically for those clients. Usually, our classes, and in the past, were offered in person, but during this quarantine, we're going to be doing Zoom calls. We will record these to be able to make an online library. Feel free to share them with your friends who you think may benefit. Because this is a recorded call, please hold all your questions to the end. We will stop the recording at that time and take questions and answers and have privacy. Today, our topic is finding cash flow in uncertain times. We're excited to have our featured expert, who's Lee Smith with Fairway Mortgage. I've partnered with Lee to work with clients, and I appreciate his expertise and follow-through. Good morning, Lee. Please tell us about yourself and your background.
So, like you said, my name is Lee Smith. I live just outside of Lone Jack, technically Pleasant Hill, but it's kind of out there a little bit in the country on that end of it. But I've been in the Kansas City area since about 2008. Been doing mortgages since about 2000, or got back in the business around 2012. So I've been kind of been working pretty strong in this field for the last 8 years.
Great. How is everything really going in the mortgage field?
Oh my goodness, it's a mixed bag right now. We're seeing all sorts of different things that we have never seen before in our industry, just because of the sheer fact of where we're at. Right now you have a whole industry such as hospitality that really can't work based upon stay-at-home orders in multiple states. You have people that work for factories that have gone on temporary layoffs because of all this, and so it is definitely creating some anxiety out there among clients. And the typical question I have to ask any client right now, no matter what we're doing, is how's work? Are you still employed? Are you planning to still be employed? Because of the amount of unemployment claims that have been increasing, and of course on a traditional mortgage, you cannot get a traditional mortgage, if you don't have a job, and so if you don't have that payment coming in or that cash flow. So it has definitely created more work on our end, and it's been a lot busier on that end of it because they're now adding more steps in than what we normally have to deal with. But as a whole, I feel like we're still healthy, we're still strong. I work for Fairway Independent Mortgage Corporation, which is the 5th largest mortgage company in the country. And as I joke around, we're the largest company you've never heard of. And we are privately owned on that end of it, so it's been very nice and beneficial. I would say out of the top 5 mortgage companies out there, we're weathering this probably in the best situation, just because of the way that our company deals with cash flow and just be able to do what we want to do. Because I've heard some stories from, let's say, Quicken would be a good example, the #1 company out there, just of struggles they're having with just the amount of volume and everything else. So it's a mixed bag right now, but my biggest thing has always been providing a service and education to clients, and that's what I continue to do. And a little slower sometimes in the responses right now because the amount of phone calls, but we're at least doing the best we can to educate and enlighten clients.
That's why we like working with you, Lee, is you have the same heart for education that we do. So tell me a little bit about what you're thinking when you hear about the forbearance. Some people, I think, oh, easy out, but aren't there some things we should consider about that?
Yeah. Forbearance is not forgiveness, and that is the most important thing for people to remember. And there is no way, and the way these mortgages are set up, it doesn't matter if it's FHA, VA, USDA, or conventional Fannie or Freddie, the payment's still going to be due. And we were just on a call yesterday that really broke all this down quite a bit. And what it was essentially was giving examples of what happens. So I mean, if anybody feels like they're in that that setup. They need to, typically online may be the best way to go where the servicer is and go online and see what resources are there. But most of the time it's going to require a phone call into the servicer. And we know some of the big dogs out there have over 30-minute wait times just to talk to somebody about this situation right now. And the most important thing, if an easy example is let's say if your mortgage payment's $1,000 a month, and you qualify, and right now it doesn't sound like it's hard to qualify for the forbearance from what we're being told, but if they give you a forbearance for 100 or for, let's say, 90 days, so 3 months, at the end of that 3 months, you still owe the $3,000, $1,000 for each month, and you also owe the mortgage payment for that month due as well. So you could find yourself in 90 days owing $3,000 to $4,000, right out of the bat. Now, some of the servicers are going to work with you to maybe try to spread that out over a 12-month period, but all of a sudden, you went from $1,000 on your payment to maybe $1,500. And so you have to catch it back up. I mean, maybe they do some different things with it, but the biggest key is if you can make a payment. Even our servicing company was saying that when we service a lot of our own loans as well. They're even saying even if you can make half the payment, $500, still make something, because it doesn't put you in as deep of a hole later as it may. So that's a real quick, brief thing. I mean, that can be a whole nother issue there. But the most important thing is if somebody, it's great if you absolutely need it because of your job situation right now, but do not think that you're not going to owe that money at some point. And in a lot of cases right now, it looks like you're going to owe it within the next 12 months. So definitely as a last resort, that would be the way I would normally recommend anybody taking a look at that option right now.
So if a person really can't make the mortgage payment but doesn't want to use the forbearance, because even later if they wanted to refinance because they used forbearance, they'll no longer have that option, should they pull from their investment income?
Well, what we don't know right now is how they're going to take a look at somebody that had been in forbearance during this. And so we're in very much of a moving target world right now to where they could come in and say, typically, traditionally, if somebody has the most common thing we see forbearances on right now are student loans. And typically an underwriter's question when they see a student loan in forbearance is, okay, well, what's going on here? Why is this in forbearance? Is there an issue here? Is there something we need to know about? And the question will be is if we get 6 months from now, 8 months, a year from now, and they see that mortgage was in forbearance, how is that looked about? How is Fannie and Freddie and all the other agencies out there going to take a look at that? Is it going to be a black mark or not? We just don't know that yet. My guess is that they're going to be lenient on something like that, especially depending on the industry they're in. As far as somebody should pull from investments, I mean, obviously that's always a great discussion for them to have with their advisor to really dig deep on that. I mean, right now with everything being a lot lower in the market, and as I joke around, I purposely have not looked at my investments for well over a month now, just because I don't want to, blissful ignorance. But it's always a great discussion to have. I mean, I typically do not, personally, I would not pull when the market is down if I don't have to, because you lock in those losses. And so, and that normally comes from, that comes from more of what I've read from financial advisors over the years, and especially with what my focus has been. But, it's definitely, before they pull money, before they panic, it's definitely great to have a great rational conversation with their advisor to really dig deep to make sure that they're not acting on emotion or fear. They're acting based upon logic. And any really any qualified financial advisor is definitely able to kind of walk them down that path.
Right. And part of where I go with that, is what are other options that we have some extra cash flow right now? So what's going on in the market? What's the biggest interest right now?
So, I mean, for my clients that are 62 and older, one of the biggest things I have seen as of recently, actually, and it's a field I've been working in for the last several years, is, really the interest within reverse mortgages. Because, we're seeing that clients that are 62 and older are basically being told stay at home based upon that they're higher risk for the virus, COVID-19. And, the reverse mortgage, while it had a bad name and stigma over the years, really isn't what most people think it is. And it's where I have the most, I guess, fun with it is the education piece of it, to really kind of break down what it is And a lot of what I do on that, when we start having that conversation or somebody calls me telling me they want a reverse mortgage, normally the first question I ask them is why? Why do you want one? Just to make sure I understand, what their reasons are actually what the product can do and help them with. And so, I mean, if they're under 62, they could always look at potentially refinancing, but if they don't have a job or, try to lower that payment or anything else, if they don't have the income coming in, that could be create an issue as well. But definitely for my, crowds over 62 right now, I'm seeing quite a bit happening on that end.
And how does we call it the home equity conversion mortgage, the HECM, how does that really work? Can you explain some of that?
Sure. So you're right. It's called a HECM, a home equity conversion mortgage, which is also known as reverse mortgage. They are backed, especially the ones we do here in Missouri and Kansas for the most part, are backed by FHA or HUD on that end of it. So they give certain guarantees as part of it. And I think I'll share my screen here in just a second. I'll kind of give some basics here as I get them pulled up as far as what has to happen and what you have to do in order to qualify. So let me do the PowerPoint here, and let me select share. So to be very at its very core, in order to even to start to think about going this route with the reverse mortgage, if I make that, okay, there we go. You have to be one person in the house has to be 62 or older, which is you can have one person over 62 and one under 62. I've got a couple of those I'm working with right now. The home has to be able to qualify for an FHA loan, which is something we talk about in the discussion, which most houses do. We don't really have a whole lot of problems there. You have to live in the home. It has to be your primary residence. So it says here, must live in the home 6 months or more. The biggest thing we see with that is if you want to be a snowbird, completely fine. I've got several clients that are snowbirds that have a house in, Texas or Arizona or wherever else, but they call Kansas City home. And so with that being the fact that, that's a pretty easy thing and that's not very difficult to do there. And we say here it generally will not affect their Social Security and Medicare benefits. It actually won't. If they use funds or if they start to use cash flow from the line of credit, which, depending on what the equity stance in the home is, all that money is tax-free. And so it does not affect, Social Security has could be taxed up to a certain percentage based upon your income. You don't have anything like that to worry about on that end of it. Just real brief, a couple big benefits and maybe to dispel some biggest myths that I hear out there is people say all the time that they lose their home, that they no longer own their home, which couldn't be farther from the truth. They still keep title on the home. They still have, they can sell the house at any point they want. So they're allowed to, if they decide to sell the home in 5, 10, 15 years, whatever, they still pass the home off with however their estate plan dictates it. The big question is, what about my heirs? And I normally say, well, it depends on how you set up your estate plan. If they don't have a good estate planning attorney, I'll definitely try to connect them on that end of it. But the heirs get to decide what happens with the home. Really, the biggest unique thing about this product is I don't necessarily have to have you don't have to have a job to qualify. You need very little income to really qualify for these, because what we're trying to qualify people for is to make sure they can pay their taxes and insurance. And so at the bottom of this slide here, it says you never a monthly payment, but you're still responsible for maintenance, which would be like your HOA dues if you're in an HOA. But for the majority of my clients, as long as you pay your taxes, your insurance, and as long as you live in the home as your primary residence, then you'll never have a payment due. Payments are optional. You can make a payment if you want to. And I was on the phone last night with a client that we talked about that, talked about the pros and cons of making a payment within a reverse, just so she kind of understood, her different options on that end of it. But what this really allows somebody to do for the most part is not to have a required monthly payment and to hopefully free up cash flow. And that's, typically the biggest thing we see on this.
Great. So what kind of research has been done on this? Because I know, like you said, people think reverse mortgage and they remember the old ones. So what research has been done to show that, I think about Dr. Fowl. You want to tell us a bit about that?
Yeah, so and actually this one PowerPoint I do quite a bit. Dr. Fow, so Dr. Wade Fow is a PhD. He studies, he basically started at the American College for Financial Services, the RICP designation, which is the Retirement Income Certified Planner or Professional. The P is either one of the two. But and essentially what he looks at and what he does is he studies on how does retirement, what are some of the best avenues for retirement income? And he's looking across the board. So he is not a financial advisor in the sense of he's more of a researcher that really digs deep and doesn't really have emotional attachments to anything. And, he even talks about quite a bit, and this is one of my favorite quotes, is when you use it strategically, a reverse mortgage can greatly improve the sustainability of your retirement income. And what he means by that quite often is when you start to take a look at all the retirement assets you have out there, whether it be IRA, Roth IRA, if you have an annuity out there, if you have a permanent life insurance policy you can draw off of, and the house, right now we've lived so long in the world of, well, we want to pay off our house. And when you really take a look at it, a lot of times a house is $250,000, $300,000, $350,000, depending on what somebody's house is worth. And all of a sudden, a lot of people have the largest amount of money tied up in one single asset. Mm-hmm. So it's almost like asking, what other single stock would you go invest $250,000 in? I always joke around, and my phone here, my iPhone or whatever, probably costs them $15, $20 to make them, give or take a little bit, and they sell them for $500 to $1,000, whatever that price may be. And the funny thing about that being is, should I put all my money into Apple stock? Because their profit margins have been big, they have a lot of cash, it seems like a good company. And most advisors will even tell you, no, that's not a good idea. It's not putting everything in a single stock is never a good idea. But yet we've gotten this notion with the house that we should have the house paid off at retirement or prior to retirement. And the one thing that I work with a lot of advisors on, and just being unique with this and using, people such as Dr. Fow, there's Dr. Fow's put out research, Dr. Barry Sachs, who is actually more from a tax side of everything. He wrote a brilliant article about how the heirs can use the mortgage interest for their own benefit after their parents have passed, which is just a great tax loophole that can be used. It's perfectly fine. It's in IRS code. John Salter from Texas Tech, Boston College has done research on this. There's been a lot of research done on it. I mean, Dr. Fow's even written a book, that is very good. It's more, I give it to my advisors because your average consumer, it gets very analytical. He runs, quite a bit of Monte Carlo simulations, which is basically just running, simulations based upon how long money will last and everything else. And the one thing that's consistent across everybody's research with the reverse mortgage is when you use it as a coordinated strategy with other retirement assets, you will end up having more money at the end of your life than you do if you use it as a last resort, which unfortunately has been the reputation it's been received over the years, is that you use all the other assets, then you come to the reverse mortgage, when in theory, when that is just a flawed concept, because he has run thousands of Monte Carlo simulations, and every single time you do it, if you use the reverse or you start the reverse mortgage at age 62, when you can, as soon as you can, you have more money. And it's just essentially all about, if you don't have to make a mortgage payment anymore, why would you? Mm-hmm. And if you can shut that off, the other kind of way to take a look at it is, why will we take money? Obviously the last couple months without standing, but if you look at the last 20 years of what the S&P 500 returns you, you're typically around 7 to 8%, depending on how you're allocated. I mean, that's just a very general statement there by all means. But your house on average is going to return you 3 to 4% a year. On average, the market should hopefully be about 7 to 8, on average year. So why would we pull money out of something that's earning us maybe 7 or 8% and putting it in something that's 3 or 4%? And so I've gone in the camp, of a lot of stuff I've read is, and what I'm personally doing myself is, instead of putting an extra $500, let's say a month on my mortgage, I'm investing that amount. I'm putting it into the market, and I'm going to keep doing that, even that, because I do believe in the market is going to return you better return over the years than a house will, especially with interest rates being as low as they are.
Right, right. I was just listening to a podcast with where Dr. Fow was being interviewed yesterday, and he was talking about strategically alternating the use of funds. I think that's what you're talking about, that you can use from investments at one point and home and back and forth as you make that financial plan to be able to use it to your benefit. And it was a really good podcast because he was talking about if you take your investment funds early, well, then there's not as much to grow. And when those simulations you discuss, I'm assuming you mean as he runs the numbers of when you take it from here, investments, and now it can't grow, as opposed to taking it from here, home equity, you let this continue to grow over here and use the funds over here that were a cheaper rate anyway. So, I mean, it makes sense when you run numbers. But thinking about that, so who is the right client for a HECM? Who's your ideal person that could use it?
Well, I mean, Dr. Fowl has even put out there that 90% of the people over the age of 62 should be looking at this as part of it. Now, he says looking at it because, should everybody do it? I mean, the research is becoming more and more prevalent that they should, because even as you were just speaking of, the biggest risk in retirement, and I heard a gentleman, we also sponsor the Financial Planners Association, me and another gentleman in my office, and we heard a great speaker back in January when we could actually meet, in person. And Michael, I believe his name is Michael Kitness, and he's over from the East Coast. And I apologize, I don't remember the company he's with, but just a big name in the industry. And he said, and if I remember this correctly, that the 5 years leading up to retirement and the first 10 years after retirement are the most important years as far as how your portfolio swings. And by that, they mean essentially, and this is what Dr. Fowl alluded to yesterday, is, or on that podcast I sent you, was the sheer fact of sequence of returns risk. So the idea of sequence of returns risk, just to keep it very simple, and I'm sure if a financial advisor's listening to this, they're probably going to be like, oh, it's a lot more complicated, and they're right. But essentially the idea behind sequence of returns risk is when you have a negative year in the market, you really don't want to pull from your investments, right, because you lock in those losses. So if you're down 5% and you need 5% to live on in that year, you're effectively down 10% in one given year. And what happens over time, and Dr. Fowl has actually done the research to show this, is that if you did that throughout the rest of your life, or a typical life cycle for somebody that's retired, you're more likely to run out of money. And the idea, for example, of using reverse mortgages as part of that strategy is the sense of in a down year that, let's say we're down 5%, well, instead of pulling from your investments, if you have money sitting in that line of credit with the reverse mortgage, 20, 30, 40, I've got some clients that have $200,000 sitting in equity they can access, you pull that money from the reverse mortgage. And so you're not paying any taxes on that. So effectively, you almost made your tax basis that year zero anyways, depending on what you and your tax advisor figure out. But you leave the money invested for it to catch back up. Because every time we have a downturn in the market, the one thing that's consistent is we do catch back up. Now, is this going to take us 6 months to get back, a year? I've heard varying opinions, obviously, on that side of it, but I do have confidence. We're not as bad as what we were in 2008, and I think that's the big message for a lot of people. Is this is not, and this is, I heard an economist yesterday on a local radio station say this, is that we're not as bad as 2008. And so, with that being said, it's not time to panic. It's fine. But if we can avoid, let's say, March, April, and May, and maybe even June from pulling from our investments, because if we don't have to, we can pull the money from the reverse, then it allows that money to catch back up, and then you get yourself back in a positive ground. And, Dr. Fowl did a research paper about a year ago, very interesting read, that, he really broke that down. And he really said, hey, here's how missing or taking one distribution from the reverse mortgage and avoiding taking money from your retirement can actually lead for your heirs to have an extra almost $200,000 30 years down the road, opposed to if you just pulled from the investments. And so very interesting read on that end of it that was published. I think it was about a year ago, because we had Dr. Fowl in Kansas City about a year ago speaking to the Financial Planners Association.
Wow. Okay, so now we've talked about all the technical stuff, the research. Let's put it to the brass tacks where the rubber meets the road. What kind of examples do you have of people that are doing these mortgages? Because I know you've been working with them for years now. You're kind of like the guy in town that does these.
So yeah, I mean, I've actually now become licensed in Illinois and in Colorado just based upon need. I've got a lot of advisors I work with. I'm working with some advisors out of St. Louis, so they've got clients across the state line. No different than kind of how Kansas City is set up with both Missouri and Kansas. And then our branch has got somebody that works out in Colorado, so I've got a couple of these I'm working with in Colorado right now as well. But some of the most common examples I'm running into, I have a client that we should be closing on Monday. He's buying a house. He actually has a reverse mortgage. I did not do the original one because he got it about 10 to 15 years ago, I believe. And house is in Kansas City, Missouri. After everything is said and done, he's still going to walk away with about $270,000 worth of equity in the house. And he's 86. He's buying a $245,000 house, I believe, and all he has to put down is about $95,000. So after Monday, when he sells, he's going to have no house payment. He's going to, of course, pay his taxes and insurance, HOA dues, and live in the home. But he's going to walk away with an additional $160,000, $170,000 in his pocket. Now, of course, he's going to talk to his advisor about it and figure out what's the best plan for this money. Where should I put it? And that's what I highly encourage on that topic, is for to have a real discussion on it. But he could buy that home for cash. I mean, he's got the money to do it. And frankly, if for some reason, because it was kind of a last minute deal that I'm working with on here, and that may have to happen depending on if we have a hiccup along the road, but we're still going to do the reverse regardless, because he wants the liquidity. He wants the access to the money. And so, which, makes a lot of sense on that end of it. I've got other clients that are using this to help pay for one of their spouses in-home care. I've got a client up in the Northland where she's a power of attorney for a mom, and mom needs care. And so we're working through that process. Even though somebody is mentally incompetent, as long as there's power of attorney, there's a little extra steps we have to go through. It's a little more of a process, but they're just doing it for protection for everybody involved. But they're using this, the house appraised for quite a bit. The house is actually free and clear, and this is going to help mom for the next 5 to 7 years with in-home care costs, because she don't want to go into a facility. She doesn't want to go into that, that type of environment. I've got other cases to where, the client I talked with last night has got her mortgage payment with their first and second about $1,200, give or take a little bit. Her Social Security check $1,600, and she still has about $200,000 in an investment account, but she's going to bleed that dry over the years. And so as her and I, we basically had an hour and a half conversation, because she got the paperwork. We went, we were going over it, page by page together. And, she had some concerns, which is, always great. I always appreciate, we want to ask a lot of questions. And, when we really take a look at it, when we looked at it, I said, the goal of what this is going to do for her in this case is make it to where we don't have to pull as much money from the investment account. Because if I can free up $600 or $700 a month out of that budget, because taxes and insurance are still going to be paid, but the principal and interest, if we can eliminate that portion of it, it's going to allow that Fidelity account that she has in this case to last a lot longer. And so, that's always the key. People look at this sometimes just as a single event. And the biggest thing that I always want people to look at is you want to look at it as, kind of, and I'll share it here, kind of, we talk a lot about a 3-bucket approach in your life, as far as for your working life or whatever else. And you essentially have 3 buckets. From 18 to 61, you get your W-2 wages, however that comes in. And then, of course, pre-retirement, you're putting it in here to your nest egg. And then, of course, you're required, if you have a house payment, obviously, to put money in your home equity. Well, as soon as we turn 62, though, we can eliminate, we can actually take a look at this different, because I've still yet to find a good reason of why we should pull money out of the nest egg, essentially 401ks, whatever that is, and put it over here in the house when we no longer have to. And so we can officially, and what we're doing with this one, this client that I was talking to last night, is I was talking to her, is we're going to close the lid of this bucket, essentially, where she does not have to put another dime in there. And so all of a sudden, she's going to have 2 buckets to focus on: her Social Security and her investment account. And, obviously at some point that investment account may run out based upon life circumstances. However, if we eliminate, the amount she's pulling out right now by closing this bucket, it's going to give her, a much better fighting chance on that end of it to allow that investment account to last a lot longer. And that's really, at the end of the day, this is not a silver bullet. I never approach it that way. This does not fix retirement or anything such as that. But what it can do, and what I try to always preach to my clients on this, is that it gives them an option. And in retirement, options are the most important thing to have. And I told this particular client, I said, look, I can see what's coming down the road for you because I've seen it before. I've got clients that half their mortgage payment is going toward, or half their Social Security check is going towards mortgages or to their mortgage payment. And it's not sustainable. Their kids are helping them or whatever else. And that's when we have that conversation with the kids involved and say, hey, look, is this, if this is what you all want to do, that's fine. It's your life, not mine. However, what if something else happens? How much can the kids help mom and dad in some of these circumstances? And so, she has options right now, and that's what I've been preaching to her. You have options. You can do whatever you want to do. Mm-hmm. However, I think we all know what's at the end of the tracks, and the better we can prepare for it, gives her, at least it gives her hopefully a better standard of living, throughout her retirement.
Yeah, I agree. That's the thing that we believe is as we give education, it gives us options. That's what's so crucial is we want to know all our options. If we don't go do the research first, and then we're in a crisis situation, we just eliminated a lot of our choices. So I appreciate you sharing. And you were talking in your current clients, some people think these are just for pulling out the equity and using it as a line of credit, but you're also able to do it through purchase. Did I see that in your PowerPoint where you talk about how to use it for a purchase as well? Like for clients,
Yes.
the home isn't a good fit. Right now we're talking about finding cash flow, but what if the home isn't a good fit? Not only can we find cash flow by not making a monthly payment, we could find a house that's a better fit for us.
100%. There's basically three different ways that a reverse mortgage can be used. Is, through a lump sum as far as a purchase or a refinance, and by that it means we're going to eliminate a mortgage payment. So one of the questions we always have is, do you stay or do you go? Does this house fit you? Is this something that, you can age in place on? There's a lot of people right now that I find that I meet with that are in these split level homes. So as I often joke around with everybody, I grew up in Southwest Missouri. And so I didn't even know really what a concept of a split level home was till I moved to Kansas City. And then they're everywhere, right? I mean, there's not, we had a ton of ranches where I grew up, ranch style homes, and those are like a diamond, trying to find those are just like a diamond in the rough, frankly. And so, that's a big question we have when we work with this product is, can you age in this home? If the question is yes, then we can look at trying to refinance and eliminate the mortgage payment. If that question is honestly no because of stairs or there's concerns there, then yeah, that's when we can really get into the discussion of what's the purchasing power with it. Because when you can buy a house and basically put about 50% down, give or take a little bit on the math, it makes it to where somebody could go sell their $175,000 split level home and go buy a $300,000 house and never have a payment again whatsoever. And so it's just such a cool aspect to be used there. And to kind of piggyback off, the other thing that we see quite a bit, obviously, is that line of credit that we kind of talked about a little bit. And that's something that if somebody has a free and clear house already, I get a lot of comments, hey, my house is already paid off. How does this benefit me? Well, as I joke around, if you like compound interest, you'll love the reverse mortgage because of the way that the line of credit actually pays a rate of return if they're not using it. And the word guaranteed is correct here. It can actually guarantee to grow. And so if they don't use it, I mean, some of my favorite examples, and I think, and actually here's a good example of kind of how the line of credit could potentially work depending on the client's age. Now, granted, I know we don't have a whole lot of $600,000 homes here, but the PowerPoint, yeah, I was going to say Colorado, but this is kind of from one of what Dr. Fow's stuff is that depending on what that line of credit will grow if it's just sat there and it's not used. And it could grow at a higher rate, and it could go past what the home is theoretically worth. And in that case, the reverse mortgage is what's called a non-recourse loan. So as I joke around on it, you're guaranteed not to lose. So basically by that meaning that if in this event to where the line of credit is increased so much higher than what the home is worth, then I would say at that point, pull the money out of the line of credit, park it in your checking or your investment account, whatever you and your advisor decide on that, park it somewhere else, because if somebody passes away and this thing is upside down, it does not chase the estate or any other asset that's out there. And so, the important distinction that most people don't realize is when you do a traditional mortgage, you are personally liable for that debt. You are going to pay it. Like on my personal mortgage right now, yeah, I have to pay it no matter what. On a reverse mortgage, the loan is actually on the house, not the person. And so what that basically means is that the house is going to pay it back, not the person. And so with that being said, is that if it's upside down, then really the loan didn't cost you anything, and you got all the uses out of it, as far as what it is. And so, that's the most important distinction that people really get confused there. They're like, well, I don't want to lose the house, or if it goes upside down, or if I run out of my line of credit, as long as you pay your taxes, your insurance, your HOA dues, and you live in the home as your primary residence, you are there until you can no longer permanently occupy it. No questions asked, doesn't matter. And if it does go upside down, then that's there's FHA mortgage insurance that takes care of that. The two cases I've seen in the last 12 months where these were upside down had nothing to do with the reverse mortgage, had everything to do with the condition of the property. As far as one property in Raytown has foundation issues, which wasn't the fault of the reverse mortgage. It's, obviously just a foundation thing. And another one that I helped a realtor in the Northland with was the wife died 4 or 5 years ago, and the husband just stopped taking care of the house. I mean, it was, when I saw the appraisal, it was a rough house. Now, granted, it was, issues or whatever else, but that house was upside down by $20,000 because of the condition of the home. But he went to go live with his kids because he couldn't live by himself anymore, and that negative $20,000 balance doesn't chase him or anything else out there. So you walk away from it free and clear at that point. And that's a very important misconception people have out there, that somehow it's going to come after my other investments or anything else, and it cannot and it will not, based upon the way they're set up, especially since FHA is the backer of them.
Right. Okay, so let me play devil's advocate here.
Sure.
What would be any downsides and what would be costs?
So, I mean, I joke around, the biggest downside is the amount of times you got to sign your name. You have to, we're trying to get to the E sign, and if there's something that good comes from this, and I know that's kind of a loaded phrase, but, we've been pushing in the industry for many years now to do electronic signatures based upon a lot of this, just because we can do it on the regular mortgage side, and they've been really slow to adapt. FHA, especially HUD, has been, or Housing and Urban Development, has been very slow to allow us to do that, and so is some of the investors out there, mainly just based upon fear more than anything else. And it does look like we're getting there, which is exciting. And Missouri and Kansas may be a little ways down the road, just because of there's more of these are happening in your high-cost county areas, like the closest one to us is Colorado, California. The East and West Coast are seeing a lot of reverse mortgage activity, especially. But so signing your name is obviously the biggest thing. People get annoyed signing their name a lot. That's why I'm getting a couple packages back today from clients that took a couple days to sign it because they just took their time, which is fine. Traditionally, I sit with the client and we go over it all together and go over page by page. Now we're having to do more of a virtual format. The other thing is deemed as a negative on there, and it's always on how you look at it, and some clients have this as a big deal, some clients don't, is that these are significantly more expensive than a regular mortgage. And, as I take depending on, and that's why a lot of times we have a deep discussion on how are you going to use this and what the uses are to you. Because I have sat with financial advisors and clients, went through their entire situation, and said, you know what, this is not the best option for you, based upon what you're wanting to do with it and everything else. And then I've sat with other clients and say, well, this is a slam dunk. There's no reason why we shouldn't do this. And so, with anything, as I always joke around, is I'm a huge numbers nerd. And I think you know this from being around me. I love numbers because, as I always say, people lie, numbers don't. And numbers don't have feelings or emotions, and that's really what I take a look at. So the client I was working with yesterday was really stuck up on closing costs, and I think I think closing costs were around $12,000 or $13,000. So not a small fee whatsoever, based upon what everything was added in there. But then when you start taking a look at it, we take a look at what's the break-even point. What happened? When do we kind of come out smelling well? And a lot of times, what happens, and a great visual example I use here quite a bit. And you ask, I'm just glad my wife doesn't take this cash out of my pocket. But so with a reverse mortgage, you may have less equity. That's a very true statement. And I always joke around, I use this right here, and I send this out to clients all the time, or when I meet with them, just has my branding on the back of it. But it's just a little stress $100 bill, right? This represents your home equity. it is absolutely worthless. You can't do anything with it. I can't take this right now over to Hy-Vee across the street here from me and buy groceries with it. So as we're talking through it, she's going to have a little less equity based upon closing costs, but what she's going to have more of is cash. And at the end of the day, it's, you know, when we're at the end of our lives or whatever else, it's not about who has the most of these, right? It's not about who has the most equity, it's who has the most cash. Mm-hmm. And that's the key. And so a reverse mortgage is only a good idea depending on how you use it. And that's the key. I've had clients, I've been told by a kid of a client one time that dad has a gambling problem and he's going to spend all this money at the casino. And then I said, well, if that's the case, and I talked to dad a little bit, and I was kind of getting that, that feeling as well, is I just declined the loan. I did not want to participate with it because, I didn't want to be, I don't want to give a drunk a drink, right? I don't want to be that person participating in the negative or bad behavior. Now, that is a moral thing for me more than anything else. I said they could probably go get one. There's probably no issues if they want to go to one of those online companies. But what's big for me is treating this as part of the overall retirement plan and working with their kids, their advisor, whoever that is on this, that we're going to have a deep discussion to make sure that the costs, which are higher, however, Dr. Fowl even will put his foot in his writing. He jokes around. He calls us the cheapest annuity you can ever buy. Because I also told the same client, when we took a look at the math of what her payment would be after your principal and interest and everything else, and if I just do if it was, I think it was around $650 a month is what that payment would have been. So we're looking at $7,800 a year that she was going to pay into mortgage payments. So really within a year and a half, give or take, she's already broken even. But, and she's, and the biggest thing with that being is that, for $13,000, I can guarantee an extra $7,800 in her pocket for however long she lives in that home. Right. So whether that's 5 years, 10 years, or even 30 years from now, she's always going to have that money in her pocket that she can use for whatever else life circumstances dictate on that end of it. And going back to the goal for a lot of times is if we can prevent pulling money out of the market, because the money with your advisor is always going to earn you more interest than putting money in the house. And that's a big belief of mine. And that's why we really have that discussion.
And on that client with the $13,000, what was the price of, or the value of her home?
I think we had it about $250,000 on this.
So honestly, if you buy a home for $250,000, you're going to spend $5 or $6 in closing costs right there.
Correct.
So I mean, yes, 13 sounds like a lot, but if people don't realize how much closing costs are these days, then it kind of puts it in perspective.
And I've done these for people that have had barely 2 pennies to rub together. Unfortunately, they are doing this out of necessity. And then I did one mid last year or whatever over in St. Louis for a house that was over $1 million. And she had over $6 million in net worth. So, I mean, it's any financial tool. It's how you use it and how you're planning to use it. And that's why we really dig deep and talk, we have a lot of discussion about it. I don't walk in from day one and say, oh, here's why you need a reverse, let's do this and everything else. Is I have a whole interview sheet. And I think that actually has somebody's name on it. I would actually show it to you. But I have an interview sheet that we're going to go down and dig deep with it. And that's the important thing to make sure people understand is I don't walk into a conversation thinking somebody should have a reverse. It's normally I'm normally kind of taking the approach of, okay, why shouldn't they do this? And let's take a look at it that way. And then when you start to really dig deep on the situation, I start to ask, like this client, I said, if I can free up an extra $650 a month for you, what would that mean? And then she's like, oh my goodness, that would just, take a big weight off my shoulders. And I said, okay. That's our focus, and that's the way we're going to work through this a little bit. And we were talking through it, and every time she would get concerned about costs, we'd come back to it and say, yes, costs are big. However, you're going to cash flow immediately. You're putting cash in your pocket June 1st, for example, or whatever, whenever we get this thing closed, starts immediately.
Right. Well, and it's similar to an FHA loan like a first-time home buyer buys. They pay a percentage up front too.
Correct.
And they're paying that for the life of the loan. This one, you pay a percentage up front and then a smaller amount later on the loan. So what are those percentages, Lee?
So when you do a regular mortgage, FHA charges 1.75%, And that goes into the coffers or the bucket at the big bucket, insurance bucket at FHA. On a reverse mortgage, you're paying 2% of whatever the house appraises for, or the sales price, whichever is less. And the funny thing is, people don't realize is that the reverse mortgage and the regular mortgage, all that mortgage insurance goes into the same pot. They don't distinguish them out differences. They put them all in the same bucket over there. And so on a monthly basis for a regular mortgage, you're paying, I believe, depending on your loan to value and a couple other things, but you're typically paying about 0.85. On a reverse mortgage, you're still accumulating about 0.5 on a monthly basis. And to make it clear to everybody that's listening to this later, we have an amortization sheet we go over line by line and we'll look at what your age is now all the way to age 99, what those projections are to be, and we use 15-year averages of what the rate is. I mean, we try to really get in deep to say, okay, here's what the historical averages have been. Here's how this typically works. Here's why we do it this way, or here's why this is set up. It is definitely a deep discussion to go into that and explains the mortgage insurance. But the unique thing with on the reverse side of it is it just does not require any type of payment. And so, yes, the mortgage insurance is a little bit more on a reverse than is a regular mortgage. However, FHA is going to guarantee, even if you live in that home 30 years, and if that house went upside down $100,000 because you didn't take care of it, or they built a sewage plant in your backyard, or whatever it may be, that they're going to guarantee that you're never going to lose on that. And so it's a big risk for FHA, really, when you think about it as well, that they're going to go that far out and guarantee that you're not going to lose on it.
Right, right. Okay, so let's say somebody wants to get a home equity conversion mortgage. Where do they start, especially with the quarantine situation?
Well, right now, unfortunately, we're doing everything on a virtual standpoint. And I'll pop up here kind of just my basic contact information. Oh, my address is not right on that, so I can't pop that up. So we will put, we'll get some of that information out there. I didn't realize that that slide had not been updated on that. But so typically just reaching out, they can call me. My cell phone right now seems to be the best number. Just while we're working, it's 816-830-7937. They can always call the office, and because Liz, my assistant's able to answer the phone. Our office number is 816-396-8810. They can always email me at lee@loanswithlee.com. But the number one step in this process is the education piece. And I even will send out, and I've got FedEx packages all the time. There's a great book I always send out to everybody that was written by a gentleman I know very well, and does an excellent job explaining it. He's done over 1,000 reverse mortgages himself. Has 4 boys, and one of the boys talks a great story in the book about how his kids basically thought he was ripping people off. And so he had to, it was kind of a kick in the gut is what he said, just that his family thought that, and kind of walks through the story of how he really, went through and taught them. And that 3 bucket thing actually came from one of his sons after they really kind of understood everything. Another great book that I hand out quite a bit on request is Understanding Reverse. And the gentleman who wrote this does an excellent job. It's like, I call it a Q&A book because it offers, it just has every chapter is a question. So, what are the basics of home equity conversion mortgage financial planning? What is a mortgage insurance premium? It does a very great option of a very great detail of explaining everything. And this is a 2019 version, nothing really updated for 2020. So the book is still in good shape on that end. I've got to probably order some more. But that's normally where we start out is the interview process. I send them out some information to have, and then we really start to make sure that this is a good fit for what they're wanting to do.
And that's what we appreciate about you, is that you aren't just trying to sell a product, you're trying to help a client. And that's how we feel in our real estate. If we go to a client and we can help them stay in their home, we're willing to do that. We want you to be in the best fit. Now, if it's not a good fit, then we're going to help you sell that home. But we appreciate that we have that same, we just want to serve our clients, and we know you do too, and I thank you for that. So do you have anything else before we open it up to question and answer?
No, I mean, for anybody that's just listening later is, there's never a harm to have a conversation. I've talked to several clients in the last week that we kind of talked through it, and they're like, I just don't really think it's a good fit for me. And we talked about it a little bit more, and they decide not to do it, which is fine. At the end of the day, I mean, it's as I tell everyone, I always appreciate the conversation to make sure that they understand it. I don't want people to make a decision based upon fear. And too many times right now that clients are making decisions based upon what they think they know and not what's actually the truth. And that's always the crushing thing, is when somebody, I've had clients that won't even talk to me. It's like I'm the Antichrist or something, and won't even have a conversation because of certain people, whether it be that they've seen on TV or radio or heard on the radio or whatever else. And at the end of the day, any negative article that's been written, especially in the last 2 years on the reverse mortgage, are typically editorial pieces that have been written from a bias standpoint, not so much from the factual side of it. And I always love discussing those articles. I'm one of those rare people to where we can disagree and we'll still be friends, right? I mean, I'm not in this culture to where if you don't agree with me, you're a terrible person, like it seems like unfortunately we're in, especially politically. And the funny thing is, back in October, there was an article written that everybody complains that nobody in Washington ever agrees on anything, right? I mean, that's always the big thing. Nobody agrees. And actually the reverse mortgage, or the HECM product, is one thing that both sides agree on. Now, of course, each want to make some changes. And frankly, the changes that both sides want to make, we're not really opposed to in the industry. We actually think some of them are very thoughtful and very good. We just always want to make sure for over-regulation to make something more difficult. But the home equity conversion mortgage is one thing that both Democrats and Republicans have said in open session in these meetings that, yeah, this makes a lot of sense. This is a really good, great product and great option for seniors that they need to have access to. And so that's my biggest thing for everybody, is just because you call me doesn't mean that, I'm like probably some of these online companies or these people that work in a cubicle 1,000 miles away that's just going to start hammering you on stuff. Normally I send you the information. I'll follow up a couple days later, then maybe a couple weeks later, just what questions you have. Is there anything I can answer? My biggest thing with everybody is if you're going to tell me no, that's fine. No issues whatsoever. I normally want to make sure to understand, I want to always know why you're saying no, just to make sure you're saying no for something that's true and not something that your neighbor told you because of what they heard. Or, I always joke around, people like to Google stuff all the time. And I tell people, look, Google the subject. That's fine if you want to Google it. But just like, I normally had joked around a lot before all this has gone out. But if I Googled the cough I had, I'm dying of cancer or something like that, just because of how extreme some of this stuff goes. And so, I believe about 10% whatever I see online anyways, just because you always got to consider the source. But if people want real, legitimate research or sources, I'm always happy to point them to them. I save a ton of the articles because it's academic research, basically. And I think that's the best way to deal with editorial pieces or just figureheads talking on the radio or on the TV or whatever else.
Right. Well, great. Lee, thank you so much for giving us this time today. We certainly appreciate it. We'll be doing other interviews and following up, and look for more interviews of ways that we can help you on our online library. I'm going to stop the recording now, and if anyone has any questions, they can either send them to the chat or just unmute yourself.